All right, so we're in the technical materials now, page 13, and we begin this flight. Starting off with line 6, Bill C5. So what we're going to do is do like a 30,000-foot view of the legislation that's out there, where it's at. Just a couple quick points on it. Once we got the feel for that, then we'll get into more specific things a little bit later. Line 6, Bill C5, the One Canadian Economy Act. So this has received royal assent. This was the focus, line 13, on removing federal barriers to internal trade and labor mobility, and also to advance those large projects in different parts of the country. So this is not a tax thing, but it's more of a business thing, and sort of be aware of it. Your professionals might be able to move a little bit easier now. Regardless, this is what we've got. Line 17, Bill C4, Making Life More Affordable for Canadians Act. This one has not yet received royal assent. So it's on its way. It's in its second reading right now, but this is not yet law. Now, it's unlikely we'll have a change in government in the near future, so this probably will go through. But let's look what's in there. Line 26, changing of that lowest marginal tax rate. For 2025, it will go down 0.5%, and then it will be fully implemented for 2026, going down that full 1%. This bill also included line 29, that first-time home buyers GST rebate. And this is almost retroactive in effect, so we need to keep our eyes on that. We have the repeal of the carbon tax and all the things related to that. Going on to page 14 of the notes, line 4, the Strong Borders Act. This one has not yet passed either, sort of same scenario as that first one. Not specifically tax, but this could affect a lot of your clients. Go to line 11 here. It would prohibit businesses and charities. Okay, so not just charities conducting businesses, but your clients, your small business, your Marsharks out there, from receiving cash payments of $10,000 or more. Cash payments. That's the key thing, cash payments. So things are going to be electronic. Things are going to be more trackable and traceable going forward if this passes. And Canada is not the first country to do this. It's happened in several countries around the world as well. If we go over to, and this is, by the way, to combat, it's a proceeds of crime type initiative to make sure we're not laundering money and that kind of thing. And it will be used for other things, I'm sure, as well. Line 18, we've got the Tax Break for All Canadians Act. That was that change to the HST, that temporary zero rating of numerous goods. So that is kind of in the past now. If we go over to line 31, we've got Bill C-69, the Budget Implementation Act of 2024. It received royal assent. So this is more of a flashback, sort of what happened in the last year. We would have talked about it last year. This year, we're kind of dealing with it. We're doing our first filings, our first applications for things. So just to refresh your mind, line 42, that is increasing the home buyers plan withdrawal limit. Big amendments to the AMT regime, line 45. Extending the 2-year ban on foreign buyers of Canadian homes to January 1st, 2027. So we still have, a little bit more time where we've got these foreign buyer restrictions. Page 15, looking at line 1, amending rules to ensure eligible children automatically get access to the Canada Learning Bond by automatically opening RESPs for eligible children. If you want to write something down here, you can just write down 2028. That's when this would really start. In 2028, they'd start registering 4-year-olds for it. That is where this will start. Going down a little further, line 15, the denial of deductions for non-compliant short-term rentals. So we got a little bit of experience with that. And that's all I want to mention for this one. Moving over to line 27, the Fall Economic Statement Act, Bill C-59. So that was all those IBTs, intergenerational business transfer rules, employee ownership trusts, SCAR, EIFEL, a few things like that. That is going to take us to page 16 and some finance releases.
Yes. So, what we got this August was a whole lot of packages of detailed draft legislation. We're kind of seeing a trend emerge at the Department of Finance, where in the summer, finance is being kept very busy, and we have lots of these significant releases. 2025 was no exception. So, we have summarized the key provisions of these several packages of draft legislation for you in your notes. Critical stuff that are going to impact our Mark, our Marcias, our Marshark clients. We'll be digging into them throughout the session today. But just as an example, on line 38, that proposal to broaden Section 44.1, which allows a rollover of the capital gain realized on the disposition of eligible small business corporation shares. Well, we got the details of that proposal in this August 2025 package of draft legislation. We also have on page 17, going down to line 22, another package of technical tax amendments. I think of it almost as housekeeping at the Department of Finance, cleanup measure. Sometimes Joe refers to it as kind of the repair and maintenance bill or the repair and maintenance draft legislation at the Department of Finance. This year's R&M draft legislation included some more rather substantive measures. It did include on line 29 the details which would modify the trust reporting requirements. So more adjustments, as Hugh mentioned, more questions we're getting from practitioners about these trust requirement rules. That's going to take us over to page 18. On line 1, we had another whole package dealing with excise tax matters. Not nearly as significant for us in our practice, but there are kind of a couple more limited things we're going to hit throughout the session today and over the next few days. Beyond the August 2025 package of draft legislation, we did have some other isolated packages of draft legislation released. For example, if you go down to line 25, we have the release of draft legislation related to the extension of the deadline for making donations eligible for the 2024 tax year. Important to note that while CRA has administered this change, essentially almost as if it has been enacted, it has not, in fact, been included in a bill which has received royal assent. So we're still dealing with a draft proposal here. Similarly, if we go to page 19 on line 1, we have the notice of ways and means motion. That's the step before it is included in a bill. We have that being released that included both the increase to the capital proposed increase to the capital gain inclusion rate, which we know that was eliminated. But there was another part of that notice of ways and means motion that proposed to increase the lifetime capital gain exemption. And that has also not been enacted into law. It's still in draft phase, even though CRA is administering those proposals. So that clearly begs the question, why does CRA administer some matters that are not that are not included or enacted into law, but choose not to administer other matters? We have an article coming on line 16 from CPA Canada talking about CRA's thinking behind their determination of which proposals to administer and which to not administer. And this article was drafted in the context of the proposed increase to the capital gain inclusion rate. So obviously that is a bit dated. However, the same general concepts that John Oakey discusses in this article would apply to these other matters that are still outstanding today that CRA has or has not chosen to administer. So what are we looking at here? If you go down to line 24 and line 25, there's actually a non-statutory rule in the House which allows CRA to begin administering proposals. So that would be drafting schedules, developing forms, building out their backside compliance systems in respect of proposed measures if they are included in a notice of ways and means motion. So that's presumably why CRA is administering that proposed increase to the capital gain, lifetime capital gain exemption. Now, if we go down to line 30, there's also another subset of kind of concepts whereby CRA may still administer proposals even if they're not included in a notice of ways and means motion, but only if the draft legislation is essentially final enough, clear enough. So what does it mean? We need line 35, draft legislation provided. On line 36 is final, not subject to consultation. And on line 33, there is no incidence of taxation. So no increase in taxation or broadening of the taxation base. If we hit those three conditions, then CRA can choose to administer the proposals that have not been enacted into law. And presumably, when we're looking at the extension to the donation deadline for making those 2024 donations, this is the kind of concept that I think CRA would be looking at in administering those provisions before it is enacted into law. Now, I did want to highlight one other item. If we go down to line 42, I'm sure you've had discussions with your colleagues, with your clients about the challenges we faced last year where CRA was administering that proposed increase to the capital gain inclusion rate, but we had not had it enacted into law. And there were a lot of practitioners and business owners and just individuals out there saying, well, that's just not fair. That doesn't make sense. So what we did have this year was a taxpayer actually go to court to really examine and question whether CRA could begin provisional administration of unenacted proposals. The specific issue here was that proposed increase to the capital gain inclusion rate. Where we're at today is that dispute is still working its way through the courts. The note here was more of a procedural matter that allowed the dispute to continue through the courts. So whenever the ruling comes out, it'll be interesting to see what the court thinks about CRA's provisional administration of unenacted proposals, remembering that there are some proposals, yes, we want CRA to enact that reduction to the marginal tax rate. But there are other proposals that we probably don't want CRA to administer if it is causing a problem, like that proposed increase to the capital gain inclusion rate. So whenever we're looking at these provisions, there's always kind of two sides to the coin to be thinking about here.
It's a bit of a gamble, Kate. I mean, I knew some clients who they wanted that increase to the capital gains inclusion rate administered when they believed it was going through, because they didn't want to have to amend their return months later and be charged interest if they couldn't file and pay based on a proposal that was going to be effective retroactively. And as you mentioned, there's a lot we would kind of like that lower personal tax rate, capital gains exemption claims on 2024 tax returns. You pain to go back and amend all of those. The charitable donations, there's a few others out there. And if they don't get that reduction to the lowest marginal tax bracket passed in the next 6 months, this will be the second time in my career that we've had to go through an entire personal tax season filing based on proposed but not legislated tax rate.
A real issue with the legislative process here in Canada, hey? Let's flip the page over to page 20, going down to line 20. We've mentioned very briefly some proposals as an example that have not been enacted into law. But you may be at your desk thinking, oh, this could impact Mark and Marcia, maybe on the sale of their business. What about those rules related to the sale to an employee ownership trust as an example? How do I go about and find out whether that specific measure has been enacted into law? And if it has not been enacted into law, where are further details? What we have built for you is on line 27, far right, a tracking document. So it's a PDF where we have included some of the kind of more significant proposals over the last couple years, and we've identified on this tracking document the status of such proposals. So a really nice tool to make use of as we're dealing with that issue as to how do we deal with these measures? Are they enacted or not? Now, that's going to take us down to some other finance releases. But Hugh, this first item, it's not in the notes.
Well,
Late breaking this morning.
it's in my notes because I penned it in, but it would have been awful challenging to release it last week when the government came out today and said, we're going to implement a new process for the federal budget. And they're all excited about carving out capital investment from other spending. And we'll see how that works. But I think what is going to impact us more is we are not having spring budgets anymore. This fall 2025 budget is the wave of the future. We will have spring economic updates in the future. The presented reasoning is largely surrounding predictability for groups like the provinces and territories, who now will be able to do, assuming they don't change their budgeting cycle, their budgets, knowing what they can expect from the federal government. And the other big group appears to be the construction sector. And they're not wrong. When you don't change the rules or announce changes until March or April, how do you plan on that for the upcoming construction season? Now they'll have a few months more advance notice. And for us in practice, hey, no more putting the brakes on and trying to avoid our personal tax clients for 2 days while we try to figure out what came down in an April budget. We don't have to do personal tax returns in November so far. No indication that's about to change.
Well, how about that? Interesting. So we'll have to incorporate that. But having said that, it is now time to get into some other finance releases, starting off with line 34. Here we have the Minister of Finance and Secretary of State for basically CRA saying that, you know what, CRA, you've got 100 days to improve your communication and some of your services. The old 100-day plan, reallocating and adding personnel, piloting a new call scheduling system, etc. So that was announced. That was supposed to be started. We got an update on that, which you can see just on your screen there. So just a couple of points from this update. They noted that in the summer, so in August, only 37% of calls to CRA were actually answered. By September, they got that number up to 57%. And the goal is in October here to get it up to 70%. They also noted that on October 20th, they plan to release a self-serve option that you or your clients can use to get access to your account again if locked out. So you wouldn't necessarily have to call the CRA. So we'll see how that pans out. And the other thing that I noted here is it looks like they wanted to put a little bit of refocused effort and resources into improving the time it takes to process T1 adjustments. So just 3 of the areas they're focusing on. Moving on in the notes, page 21. We go into line 2, the digital services tax. So we had an announcement on that day that the digital services tax collection will be halted, and they're going to basically rescind that tax and the associated legislation. The problem we've got, and this probably won't affect many of our clients, is that because the actual law hasn't passed to sort of undo it, CRA can't actually refund the taxes that have already been collected and remitted to it. So that is something that they're just going to have to wait on. Going to line 21 in the notes, we've got a release associated with all of those U.S. tariffs and the intent from sort of a multi-pronged attempt, we'll call it, to combat that U.S. tariff impact on the Canadian economy. So they're looking at ways to sort of like provide some tariff relief and also provide some financing and a few other things as well. The one thing I wanted to note is, and maybe what you can do is just put a CLR note beside this and maybe also an FP note as well. There is a web page that has been released that sort of accumulates all of these resources together. So, you might actually want to flag this for yourself and provide it to clients. It's called the UF Tariff Support for Canadian Businesses and Workers. And if you scroll down, it's got a section called Active Supports. So, duty relief program, duty drawback program, tax relief, support for businesses and responsive tariffs. So a lot of good information there. We'll just click on the tax relief and support for businesses one. And as you can see, it gets very detailed. So deferring GST, HST remittances and corporate income tax payments for that April to June period. I mean, that's past now, but that gives you a feel for the types of information that you're going to be finding on this page. Going over to page 22 in the notes, looking at line 13, we got a March 7th, 2025 release in respect of line 14, anti-money laundering framework, wrong word, framework, and all of the new regulatory adjustments that are out there. So if you just take a look at line 18, what we're talking about here is there is a requirement to report discrepancies between information provided to private institutions. So, maybe that is a bank, and the Federal Beneficial Ownership Registry. So that registry that sort of monitors and has information about corporations registered under the Canada Corporations Act, details are going to be compared between different areas. And if things are off, if there are differences there, that could trigger reviews. Maybe it'll affect you from a CRA perspective. Maybe it'll affect you from a different perspective. We don't know yet. But this basically allows different areas to talk to each other a little bit more. So you might see a little bit more activity verifying information. Who owns what? Who's the beneficial owner? Those kinds of things.
The item that strikes me as affecting us and our clients, Schedule 50 to the corporate tax return for any CBCA corporation. If it doesn't match, we've got two federal agencies who are supposed to be communicating to make sure it does. And we know CRA had a project on Schedule 50 a couple of years ago.
Oh, yeah, definitely true. And there are so many sections of the Income Tax Act that are affected by, beneficial ownership, who owns what, to what degree, all those kinds of things. Going over to page 23 in the notes, looking at line 1. So at the end of December 2024, we had the announcement giving details on the 2025 automobile deduction limits. So limits that we're, looking at and incorporating into our filings for the 2025 year. So that affects us now. We won't get the next year's numbers until probably December, so in a couple months. But just a couple things to highlight. Go to line 6. That limit is 72 cents per kilometer for the first 5,000 kilometers driven. Remember, that's the limit on the deduction for non-taxable allowances paid out, that Marshark paid out to Nick, the employee. That's for the first 5,000 K. Also on line 10, the ceiling on the capital cost for CCA increases to 38K from 37K. And we had about 20 years where it was just 30,000 per year, but now it looks like it's part of the process. It's going to be tweaked and changed on an annual basis again. So that just means it's something else we need to think about when we're filing those returns. And if we're talking about line 11, zero emission passenger vehicles, sort of the cap for that class is $61,000. That's staying the same. Going on to, and you got to think, that kind of number might go up now that we got these tariff wars and things are getting a little bit more expensive. So, we'll have to see. If we also go over to line 13, the limit on leasing costs will increase to $1,100 per month from $1,050. So the thing I just want to mention here is if you're doing the returns for Marshark and you've got all these leasing costs, you got to take a look at when were these leasing arrangements entered into? Because if they're entered into in 2025, we know that the cap is $1,100 per month. But if they were entered into in 2024, then it was $1,050 per month. And that $1,050 carries forward into the future. So you really got to keep your eyes on the initiation point. I think that's all I want to mention for this. That is going to take us over a few pages to page 25, line 15. On December 3rd, 2024, a $50 million fund was announced to help municipalities basically enforce their rules in respect of short. So, helping those municipalities figure out who is not getting the appropriate licenses, helping them out with their licenses. Those kind of things are happening. And that really affects us from a tax perspective because there's a denial of deductions if you're offside in respect to these kind of things. So, it's interesting to see this multi-pronged sort of approach to short-term rental. One other thing on this page 25, line 27 here, there was an announcement of something called a Working Canadians rebate, which was supposed to be a $250 tax-free payment for people working in Canada with income out under 150K. After the announcement, nothing happened. So it's kind of disappeared. So don't expect anything to come from that, especially since it said it was already supposed to happen in spring of 2025. Going to page 26 in the notes, looking at line 32. On October 8, 2024, we had some announcements about different things that the government was going to do in respect of vacant lands across the country. So take a look at line 36, consultation on the taxation of vacant land. So, the federal government is really looking at sort of densification initiatives and how do we use what we have right now. So maybe we force people to use what they have by increasing tax or changing the way we tax it. That consultation is closed. So we're not sure what's going to come out of it, but we do know we've got a federal budget on the horizon. So we may see something in respect of these vacant lands. Caitlin, I'm going to turn it over to you now.
Let's go over to page 27. We are in CRA releases. And before we get into the textbook, another late breaking release. The last couple weeks have been pretty busy at the CRA and the Department of Finance. So Ali is going to pop into the public chat this link that I'm going to be talking about here. And it has to do with CRA's impact as a result of the Canada Post strike, the mail service disruption. So we have lots of details in the CRA webpage here. I'm going to just highlight a few of the key takeaways. Number one, CRA is not going to be sending out checks during the Canada Post strike, except for Canada Child Benefit checks. So we still will see those CCB as well as the associated provincial or territorial benefits. We'll still see those checks going out. However, other checks from the CRA will be held pending the end of the Canada Post strike. The other types of communications that we may be waiting on for CRA, audits, objections, communications related to appeals, related to taxpayer relief requests. Maybe we had a verification. We're waiting for CRA's comments on that verification request. Well, they have said they are going to be shifting to online communication as well as communication via phone, and written letter mail will only be sent out in exceptional cases. So in particular, if you do have some of these ongoing disputes with CRA, these ongoing requests with CRA, it's going to be even more important for, I'm sure most of us are online, but more important for our clients to be online to get these communications from CRA. CRA also notes on that webpage that we've referenced that just because we have a postal strike ongoing right now doesn't absolve us of our tax payment, tax filing obligations. Similar concepts, discussions that we have had in previous Canada Post strikes. And then CRA does take the opportunity to remind you and I of the opportunity to register for online mail, to set up direct deposit so that we are not impacted by these types of labor disruptions. So that's from CRA. We did have another post from Service Canada, Employment and Social Development Canada, ESDC. We're going to put a link in the public chat here, but there is more comments there, for example, on relevant for Grandma Mimi related to her CPP and OAS payments. ESDC said, yes, we are still going to be mailing the checks. They may be delayed due to the Canada Post strike. So what they have proactively decided to do is to mail the checks early. So some of our clients may get checks in advance of when they can actually deposit them due to ESDC being particularly proactive here. So we may get questions coming out on those kind of weird timings of some of the checks. But ESDC is really trying to hopefully get those checks out to our clients. A little bit of a different situation as compared to majority of other checks from CRA. Now that's going to take us back into the textbook on line 3 as we talk about more CRA actions to shift our individual clients from paper communications to online only communications. In light of this most recent postal strike, it probably seems like a pretty good idea for some, but probably not all of our clients. What we have here, it was a pretty quiet update on one of their web pages. It was very easy to miss if you weren't alerted to it, but CRA has stated that they are, line 3 far right, changing the method of delivering most mail from paper to online only for about 500,000 benefit recipients. So lots of our potential clients, they note that impacted online 5 taxpayers will receive an email notification. Hopefully they have your proper email that they're going to be transitioned to online only mail. And then I have seen paper letters, at least before the start of the strike, paper letters going out to impacted taxpayers, notifying them that they are being transitioned to online only mail. Who's getting captured in this first transition to online only mail? Line 6 applies to some benefit recipients who are registered for, yes, an online CRA account, but currently receive paper mail. If you do have a client who did get transitioned to online only communication on the individual side, we're going to talk about the business side later in the CRA section, but in respect of individuals being transitioned, they can opt out to go back to paper mail by doing so online on My Account. One caution, what we've been hearing in some of our other sessions is that taxpayers may go onto My Account, ask and put the request in to transition back to paper mail. It looks like it goes through, and then a few hours later, 24 hours later, they are shifted back again to online only mail. So I'm not quite sure about the systems and the processes behind that. But the takeaway here is that if you do or your clients do transition back to paper mail, you're probably going to want to double check that transition stuck. In one case, we had an individual who was shifted automatically back to online mail, and it was only on her second attempt to go to paper mail that it actually stuck. So just a caution there. This post.
I'm curious, Kate, whether that might be because that was right around the time they took out the second group that they transitioned.
Exactly.
And if the first and second group are all listed and the computer just runs a sweep. So that might mean every time they add more people, we got to go check if we were re-added to online mail.
And that's a really important point. This first group I've referred to, 500,000 people. The second group, it's not in your notes because it was a subsequent update after we had the textbook finalized. Phase 2, another 900,000 individuals that were getting shifted to online only mail. And CRA noted in that second phase that it will go beyond just benefit recipients. So I'm not quite sure exactly what that means, but now we're at nearly 1.5 million individuals that have been proactively shifted to online mail, unless they took that extra step to opt out. And my guess is there's going to be more phases coming. So it's just another trend theme at the CRA to be made aware of. Now that's going to take us actually down to line 38. We have the annual report coming out from the CRA Disability Advisory Committee, providing several recommendations in respect of various benefits for individuals with disability. For example, on line 41, suggestions related to adjusting, refining the eligibility criteria in respect of presumably disability tax credit, simplifying application process for the DTC, revising what actually is the definition of a disability used across different government services. So just a little indication of what the government is looking at. We'll see if these type of changes make it and see the light of day. Now that's going to take us over or down the page, pardon me, to line 31. We have a news release from ESDC Canada, Employment and Social Development Canada, another CLR note. This talks about the expansion of the student loan forgiveness program to be applicable not just to medical practitioners, doctors, nurses, nurse practitioners working in rural or underserved communities. We did have the proposed expansion to also have these loan forgiveness programs available to on line 34 through line 36. This much broader group of professionals, early childhood educators, dentists, dental hygienists, pharmacists, midwives, teachers, social workers, personal support workers, physiotherapists, and psychologists, pardon me. Note that we are still waiting for those expanded professions to basically be made effective. So we're waiting for the final kind of go ahead thumbs up from the government. We'll see when it comes out. For the time being, though, our doctors, our nurses, our nurse practitioners, our nurses are still eligible under the program. And once we do get the go ahead for those bigger, broader group of professionals, note that our clients have 90 days to get that application in for that loan forgiveness from the end of the relevant year to which they're applying, provided they do still work in that rural or underserved community. Very helpful if we do have clients that may qualify for this pretty generous loan forgiveness.
We're going to drop down to line 42. We had the 2025 Ontario budget. No broad-based rate changes, but if we flip over to page 39, there will be a refundable fertility treatment tax credit in 2025. That could be worth up to $5,000 on expenses of up to $20,000. And in addition, they don't lose access to the medical tax credits on those expenditures. So we can do a little double dipping there. The refundable manufacturing investment tax credit for CCPCs at line 4 is getting bumped up to 15% from the old 10% rate. That'll apply for property that gets available for use from mid-May 2025, so in play already, right through to the end of 2029. Limit on the credit within an associated group is $3 million. So if I can get $3 million, I'd be pretty happy about that, although you got to spend a lot more money to get there. That's a $20 million investment. That credit is also going to be partially extended to non-CCPCs at line 9, but it will be non-refundable if you're not a CCPC. Still a lot of dollars at stake. The fall economic statement at line 12 doesn't contain a lot of new information. Most of it was repeated in the budget. They did say at line 23, hey, we finished our review of the Ontario tax system and everything seems to be perfect. Carry on, but we'll keep watching in the future to simplify and modernize the province's tax system. I'm glad we had the full review. One item that did come out of that fall economic statement that could be a little scary for some clients, line 26, the alternative minimum tax. Ontario decided that they don't like the feds raising the rate to the second bracket. So Ontario raised the percentage of the federal tax spread that they're going to charge and lowered it back down to say that'll keep the Ontario AMT at 5.05%. Okay, so far so good. Oh, but if we're going to lower that percentage starting in 24 for what we charge, we're going to lower it in 25 for what you recover. So if you didn't get all your AMT from 2023 and prior years back on your 2024 return, there's a permanent loss. You're not going to recover 33 2/3%. you're going to recover a little under 25%. Unfortunate. I guess they decided they didn't want to track two pools, a pre-23 and a post-23 pool. But I understand the logic. It still seems a little unfair that you're going to be permanently out of pocket. We're going to drop down to line 34. This was a bit of a scary case, although it wasn't directly related to an accountant. We're subject to similar record keeping and reporting requirements. In fact, we have our very own webpage at lines 38 and 39 for tracking issues related to suspicious transactions under all those money laundering and FinTrack regulations. What we had here was a realtor who failed to send in their timely reports. And if you think the penalties are insignificant, you might want to highlight at line 43, they were assessed over $156,000. That's bad enough, but if you drop a line down, $500,000 is the potential penalty. So maybe they got off light at only about 30% of that maximum. They went to court, again, a judicial review, and said, look, we're not denying we made a mistake. We mistakenly believed we didn't have to report because there were concurrent enforcement activities being conducted, but we're advised that, yes, we were required to report. But at page 47, line 2, their argument was agreed by the court. You didn't think about the mitigating factors. These guys have historically done a pretty good job filing everything. They had a reason for thinking they weren't required to file this one, nor was there any explanation of how that penalty you selected, because you have discretion, Crown Authority, was proportionate to the damage done and the actual harm done by the non-compliance. So maybe they'll get a reassessment, a reduction. Maybe not. It's just judicial review, so they get to make their choice.
So if you wouldn't mind just flipping over to page 370 in the book, a whole bunch of one-page appendixes that give you detailed information on one particular topic or the other. So let's just highlight what we've got in there. On page 370, we've got our combined top marginal rates across the provinces for individuals. On page 371, we've got sort of the same thing, but in respect of corporations and different type of corporate income. Going over to page 372, here we get into our integration table. So we're in Ontario, so we might want to just flip over to page 376 and just take a look at this chart. A couple things that I'll point out to you here. So the first thing is this integration table really takes a look at, if you were to flow money through your corporation, pay tax on it, pay it out as a dividend, how much are you left with compared to just not being incorporated, or paying it out as a salary and sort of flowing it through. So what's the difference? What's the advantage or disadvantage from an overall perspective? So if you just look at the first column there, if we're considering a corporation, maybe it's Marshark, that has small business that is eligible for the small business deduction, it's a negative 0.59%. So in other words, there's about a 0.5% cost by flowing it through your corporation and paying tax on the dividend rather than just bonusing it all out or not being incorporated. If we're talking about, let's go over to the fourth column. That's the other key column. Now we're talking about Marshark that is earning more than $500,000. Are we bonusing down or not? Well, if we don't bonus it down, it equates to about a 2.01% cost from an overall tax perspective. Now, don't forget, we still get a little bit of a tax deferral there. If you go up a little bit, you can see 27.03%. So there still is that tax deferral opportunity, but you do have this 2% cost associated with it. So overall, not a huge sort of slippage on the in the integration world in Ontario. So we're kind of looking at, external factors or other things we want to think about. So, do our clients, do our Market Marshall want to build up earned income so they can have greater RSP contribution room? Well, there you're going to have higher salaries and bonuses. So those are the kind of things we're thinking about in Ontario. The next column, and this has been fairly similar for years, the SIBI column, specified investment business income, and basically passive income, investment income earned within the corporation. You're paying about 4.4% more on an overall tax perspective if you flow that through the corp rather than just holding it personally. Now, of course, if you got an extra $1,000,000 in the corporation, do you buy public securities there? Or do you pull it out? Well, you just have to incorporate the cost of pulling that million out. When you're paying tax on it, you're reducing your capital available for investment. So you could be in a worse position. So you just got to think, do I have capital dividend? Do I have CDA that I can pull it out with? Or, what is my effective tax rate by doing that? We have a couple other columns focusing on dividends and personal services business income. Again, if you have a client, maybe it's no, it wouldn't be Marshark because Marshark does too many things, but a corporation that is basically, a self-employed individual working through the corp for somebody else, and that person's really an employee of that third party. Look at this. Your tax rates are going to increase by 12.8% or up to 17.47%. So you got to be careful there. Now, on the right side of the page, we have all of our corporate rates applicable to 2025. And then just below that, what are the CPP contribution numbers? Below this, in the middle portion of the page, we have our brackets for 2025 taxable income. So thanks to Tax Tips for sort of accumulating this data on the brackets and all the tax rates associated with each bracket for ordinary income, capital gains, eligible, non-eligible dividends. It's all there. But what we did is we took those numbers, and the last three boxes on the right are basically recalculations of the chart above using those tax rates for those different marginal brackets. The top chart assumes that somebody is in the top marginal bracket. Down here, we've done all the calculations at lower rates. But as you can see, if you just maybe look in the fourth box there, our deferral percentage, we've got in the first column. In the second column, we've got savings and then cost as a percentage. Savings, cost as a percentage, just take a look at the very bottom there. That's that negative 0.59% number we talked about associated with income earned and eligible for the small business deduction. So that's the same number as the chart above. But if you were to do the same calculations with the lower brackets, just look above that. Negative 0.55, 0.54. It goes down a little bit, but not by much. So that's why, we can sort of use the top marginal bracket as an estimate. There's not a lot of variance, but here it is right in front of your eyes in case you are curious about those numbers. So those are integration tables. Obviously, if you've got clients in other jurisdictions, you can take a look at those other integration tables. This is going to move us on a little bit further in our notes. Page 386, we have our Canada Pension Plan numbers. So if you go to line 17 of the notes for 2025, we've got our max pensionable earnings. So CPP1, the max is 71.3. CPP2, it's 81.2. So we've been on a long journey. What was it? I think about 7 years of just sort of incorporating changes each year. First, we increased the rates, then we increased sort of the coverage. And now, 2025, that was the final year of the implementation of this sort of like enhanced CPP regime. So we had a big increase this year. But next year, for 2026, from that point forward, it's basically going to increase for inflation. I shouldn't say inflation. It's actually increase for sort of like an overall average wage increases. There's a different calculation, but it's inflation-like. So it will be a smaller amount of increase in 2026 going forward. So all of the numbers are right there. Going down the page, if we look at line 32, EI, all of our EI numbers, we recently got the 2026 numbers, so I'll just read them off to you. You can put them in your notes if you want to, but you will be getting these numbers in the update email that we send at the end of the course. 2026, the maximum annual insurable earnings, $68,900. Employees' premium rate down to 1.63. Employers' premium rate 2.28. Maximum annual employee premiums, $1,123. Maximum annual employer premiums, $1,571. Total, $2,694. Page 387. We have our RRSP numbers, our TFSA numbers. The one thing I wanted to say when it comes to RRSPs is just go to line 13, go to the far right, circle 187,833. If you want to max out the additions to your RRSP room for 2026, they look at your 2025 numbers. So what is the number that will ensure you max it out? That's the 187,833. So as you're doing your T4s in February, and doing your remuneration planning, that's the number you want to focus on if RSP room is the focus for your client. Line 21, prescribed rate of interest. So here are the base rates, and you're going to do something with these base rates to figure out exactly how much interest you have to pay or are going to get back. If you go to line 42 on the far right, you can circle the 3% number. So that is the base rate for the fourth quarter of 2025. We won't know what 2026 is for another 3 weeks or so, the first quarter. But it's been going down just slightly over the last year. You take this number, you add 4% to it, that's what you're going to have to pay CRA for late amounts in general.
We should probably talk about our remuneration of the owner manager. So we're going to go all the way back to page 53 into the main textbook. And we've talked for the past few years about changes to the intergenerational business transfer rules that give us an exemption from that nasty provision, section 84.1, that turns capital gains into dividends when we have sales to non-arm's length corporations, like Mervyn and Mini buying out Mark and Marsh's interest in Marshark. So we've seen a lot of change over the past few years, settling into the current version at line 10 that kicked in effective January 1, 2024. Now, the challenge here is we've got immediate, we've got gradual IBTs. They've both got various detailed criteria we need to meet, not only at the transaction date, but you can highlight on line 13, as long as 10 years afterwards. So we've got to be pretty aware of these provisions. And as time goes on, we're going to have more and more clients who have one of these in their history and have to make sure they stay in compliance with all of the subsequent year requirements. We're not going to go through all the details. We went through the details in prior years, but we will have them in your notes if you need a refresher. What's changed? Well, line 18, it took them until late February 2025 to give us the form, because you have to elect. If the Marsharks are doing this, Mark and Marsha have to elect with Minnie and Mervyn that these IBT rules apply. We got the prescribed form a lot later than a lot of practitioners wanted, because it would have been nice to just have these filed right around the transaction date and know they would not be forgotten. Unfortunately, what we also got was a requirement on this form. I need to pick. Either we're electing the immediate or we're electing the gradual IBT. So I can't fill it out thinking we're probably going to meet both criteria. So why don't we figure out which one it is when you actually come looking and we know that we were offside one of the requirements for only one of them. We've got to choose which one. And we got to make sure they go in on time. Line 22, back in August of 2024, we got a bulky package of draft legislation, and it included a proposal that we would add these elections to the list of elections that can be filed late or amended or revoked under the taxpayer relief provisions. But that hasn't moved forward. It hasn't shown up in a bill yet or a regulatory update. So we are still stuck needing to make sure these get filed on time, because if Mark and Marsha had enough capital gains to fully utilize their CGEs, having $2.5 million of tax-exempt capital gains turn into $2.5 million of non-eligible dividends is going to be a big issue for them. And I would bet they will make it a big issue for us, the advisor, that failed to get those forms in. And as it's part of the compliance, I think even those of us that sort of look at these issues and go, well, we farm all that high-end tax planning out to experts and specialists, maybe a tax law firm, tax law firm is not going to prepare the personal tax return and make sure this form gets filed. We're going to be the ones stuck making sure this form gets filed. And we'll be the ones looking across the table at Mark and Marcia for the next, well, many Mervyn, Mark, and Marcia for the next, 3, 5, 10 years, during which they got to meet all these criteria. The lawyer's done and won. We're the ones who have to deal with the ongoing compliance obligations. One question that cropped up early on, the rule says you only get one IBT for any one business during your lifetime. So what if Minnie and Mervyn each want to use separate holding companies? Does that work? Seems like that's 2 transactions. CRA has taken, I would say, a reasonable interpretation at line 29, saying if Minnie's company buys some of the shares and Mervyn's company buys some of the shares, and it all happens at the same time, we're going to treat that as one big transaction, not a whole bunch of little miniature transactions. So they would get access to the IBT rules in their example on both sales to the 2 corporations, not having to pick one or the other. One interesting development from CRA, what if we've already done our estate freeze? And we've already issued common shares to the kids. Now we're sitting on all these freeze shares. Well, the question posed to CRA is, we've gotten an estate freeze that was done some years back. The parents, maybe that's Melvin and Maxine, are holding fixed value voting preferred shares to keep control over their corporation, and fixed value non-voting redeemable shares that they converted their common shares into years ago to take back value and let the growth go to the kids. The adult children now at line 43 have all the voting common shares. Are we too late? Can we do an IBT? Well, if we flip over to page 54, line 3, CRA said, nothing in the rule says you have to transfer voting or common shares to that child's holding company. The freeze shares could just as easily access the IBT rules. You'd have to meet all the other criteria. But remember, one of those requirements at line 9 is parents need to give up control of the corporation. So they can't keep those skinny voting control shares either. Control has to move to the children's company, whether we're under gradual or immediate IBT. The key difference between immediate and gradual, immediate, I need to give up de facto control. De jure, I only need to show that I gave up de jure control for a gradual IBT. And as de facto is a lot more subjective and uncertain, that might be a nudge to me to consider a gradual IBT rather than an immediate one, and making sure I'm going to fall into those particular rules. As well, a lot of these shares will probably not meet the requirements of shares of a specified class, which means if Melvin and Maxine want to hang on to some of them, they've only got a 3-year limit to get rid of them for most of these IBT structures. While we're not allowed to even have Melvin and Maxine continue managing any of the operating businesses. So the actual rule says they must take reasonable steps to transfer management to the kids and permanently cease management within either 36 months or 60 months, depending on whether they're going immediate or gradual, or a greater period that is reasonable according to the legislation. I don't know that I want to gamble on CRA after the fact, agreeing that my greater period was reasonable. And they haven't given any comments about whether we can go to them up front and get them to approve something in advance. So I'm thinking I want to make sure management ceases. But for Melvin and Maxine, no big deal. They did the freeze. They hung on to voting control to make sure they'd get their dividends. But the kids have been managing the business for 5 years already. So firm policy for us, do we want to go out and identify our clients that have done past estate freezes and assess whether an IBT might be a way for them to get access to their capital gains exemption? Because prior to these changes, we were stuck with these family business successions that you couldn't have a tax-effective transfer or tax-effective purchase using a holding company and still get CGE. Now we can. And we can do that with estate freeze shares that are holdovers from when we couldn't. CRA has also been asked, what does it mean to be managing or supervising the business? And CRA generally sort of gives us a very nebulous theory of the bigger your decision-making power, the more likely you're managing or supervising. But they've drawn a line in the sand and said, if they're a director at line 32, they are engaged in management or supervision of the business. Whether they're the sole director or one of many directors doesn't matter. That's a management function. Now, just because you're not a director, that doesn't mean you might not still be managing or supervising the business. And another area CRA noted at line 43, if you have discretion over fund disbursement within the corporation, that's a significant management or supervisory responsibility as well. So that's kind of my second firm policy. And now I'm looking a little closer at Mark and Marcia. You like the idea of selling to the kids' holding companies and using the capital gains exemption, but are you ready to hand over the reins? If you're not ready to get out of management and supervision, you're not ready to consider an IBT. That's probably going to be a tough thing to explain to some of our clients going forward. It's really the end of the succession, not the start, when the IBT is going to work. We flip over to page 55. CRA was asked, well, I know that for a gradual IBT, I only need to move de jure control, the voting right. That's not hard. But what about an immediate IBT where I need to move de facto control as well? CRA, do you think if Mark and Marcia are getting paid out over a long time, that would be enough to be de facto control? Well, CRA's answer was, it depends on all the facts and circumstances. Are you, in fact, holding on debt that allows you to leverage it to maintain control? Then you'd be offside and your IBT would be invalidated. Now, you could shift over and say, well, we'll just do a gradual IBT. But if you're doing a gradual IBT, then you've got to get the value of your investment down to under 50% of where you started at line 10. If you're dealing with family farmer fishing corporations, any other QSBC, you got to get down to 30% or less inside of 10 years. So while you don't have to worry about the risk of de facto control being asserted, you have to deal with the finances and repay not just shares, get rid of the debts as well. Minnie and Mervyn have to pay Mark and Marcia out at least 70% in the first 10 years. And 10 years is a long time. How much could go wrong? I got two firm policies there. The whole family needs to understand that these payments have to be made, or we could be looking a decade from now at Mark and Marcia no longer being entitled to that capital gains claim they made. 10 years is a long time for interest to build up because it'll be retroactively reversed. My other firm policy is for us. How do we track this? How do we know that a new client we pick up in 3 years didn't do an IBT in 2024 and still has time on that gradual IBT? But they got to follow these rules. Maybe that's an addition to our client onboarding process. If we have a checklist or something similar, have we inquired about past IBTs? Well, if it's Mark and Marcia coming in, they're old enough that we're pretty confident that they didn't take over the business only 10 years ago. But even there, it could be an issue. Some of those founders hang on for an awfully long time. So we want to keep our eyes open for all of these issues. One of the bigger issues when we're planning these at line 38 is relevant group entities. And this is another issue that the lawyer that gets called in to just plan the IBT itself isn't going to have the ability to deal with, because this would have to be planned out 2 to 3 years in advance. What's a relevant group entity? Well, that's a concept that was introduced by the IBT rules. If we have another entity, a corporation, a partnership, and it carries on an active business that is relevant to determining whether the shares we want to sell meet the requirements of a qualified small business corporation or a family farm and fishing corporation. So maybe that's Marshark here that we want to do a sale of, but we've got Marshark Properties, and it owns the real estate that Marshark itself operates out of. Do we have to bring Marshark Properties on side? Does it have to go with Marshark, or can Mark and Marcia retain the real estate company and keep collecting rents? Maybe that's part of their retirement income plan. Well, if we flip over to page 56, line 4, we see an example very similar to that was posed to CRA. And I'll flag the key fact that will be different in a lot of the situations I see. Line 13, Marshark has no intercorporate debts or shares going either way with Marshark Property Corp. So they're completely separate corporations. Now, Mark and Marcia, in our example, they want to sell OpCo. They're not so sure they want to sell RentCo to corporations held by Mervyn and Minnie. And they've satisfied themselves that they're okay with all the other requirements of an IBT. CRA looked at this and said, well, is Marshark Properties relevant to determining whether Marshark qualifies for QSBC status? That's an asset test. If Marshark doesn't own any shares and doesn't have any receivables from Marshark Properties is an irrelevant group entity. Forget it. You can still do the IBT. Well, then they ask the reverse question. What if we just want to sell the property company and we're going to keep the operating company, Marshark, with Mark and Marcia? CRA said, okay, well, now you got a problem, because the only reason that Marshark Properties shares will be QSBC shares is because its only asset is used in the active business of Marshark, a related corporation. Marshark's business is relevant to Marshark Properties qualifying as a QSBC. Therefore, you can't sell RentCo without also selling Marshark with it to the kids. So that's a little complex, and we went over that fairly quickly, but I think the actual specifics of the example are less important than we've got to be looking at the whole corporate group to figure out, if we want to do an IBT, which other entities have to be transferred. And maybe we're looking at Mark and Marcia today, and we do have intercorporate shares and intercorporate debt between the real estate company and the operating company. Do we want to clean that up now so we won't have a problem 2 to 3 years down the road if we want to do an IBT? Recalling that we may not even meet a 50% holding test without counting Marshark Properties assets. So we got to be keeping a look on what might come down the road. And that means even if we're not going to do the planning ourselves, we still need to understand the rules enough to do that advanced pre-planning. Yeah. If we flip over to page 57, we have some further comments on that particular structure, the unlikeliness that in the normal course, these corporations never have any intercorporate balances. So we want to keep our eyes open for that, as well as a few other possibilities. We're going to drop down to page 57, line 28. The question asked here was, okay, Minnie and Mervyn have bought out Marshark through their separate holding companies, or maybe just one big holding company, and they don't want to keep paying accounting fees for 2 sets of financial statements and tax returns every year. They would like to amalgamate Marshark with their holding company. Well, we've got an article from Canadian Tax Focus that goes into a bit of discussion here and says, first off, as long as the children's company, Holdco, owns at least 51%, then if we amalgamate, we're going to own 51% of Marshark. We still control the successor corporation. That should be okay. But what if we sold 50%, exactly 50%, to Mervyn and Minnie Co., and we sold the other half to a corporation controlled by Nick, our arm's length employee, and we want to merge all three and end up with a 50-50 Marshark operations going forward? That would cost Mervyn and Minnie control of any corporation, including their purchaser corporation, which is now part of that amalgamated company. And that cessation of control would crater the IBT back to the original purchase date if we're still in that somewhere between 3 and 10 year period, depending on the IBT. So another thing we got to watch out for, if we're doing a restructuring, a reorganization, we got to be careful we're not violating the terms of a past IBT, because that could, again, result in big retroactive deemed dividends. These are going to be really complicated going forward. If we flip over to page 58, we will note at line 8 that this is a little different from the previous IBT rules, the ones that were under Bill C-208, if you remember that particular enactment. That said that we got to keep Holdco owning the OpCo shares for at least 5 years. CRA's position there is if you amalgamate them, you violated that term. So if you did one of those old rule IBTs in 2023, you got to keep that structure intact until 2028. Another thing we got to monitor on an ongoing basis. So an awful lot of issues to deal with there. Under the new IBT rules, Mervyn and Minnie only have to maintain control of the purchaser corporation. So a little less strict in that regard. They could have Nick, the arm's length employee, buy in for 50% if that's the result that will get them where they want to be from a business perspective. At lines 22 onwards, we have reprinted the chart that we did last year on how to deal with IBTs, all of the technical rules comparing immediate and gradual, but we're in an update course and we updated that last year. So since it hasn't changed, we're going to flip over to page 61, line 35. We've had these IBT rules in place for a couple of years, if I only count the new ones, probably 5 years now, if I count the Bill C-208 ones as well. Have we been using them? What has our firm seen? Well, we got about 4% of us that are in category A. We were doing broad Bill C-208 transfers, at least until the end of 23 when the rules changed. We've got 5% of us that have done immediate IBTs under the new rules. We got 2% that have done gradual IBTs under the new rules. And we have 10% of us that are overachievers. We've done the old and the new rules, at least one side of the new rules. So that's a lot of us. We got 4% of us that, no, by the time we looked at all the requirements for these new rules, they just did a business succession without taking advantage of any of these special rules. And 3/4 of us, 75%, haven't had any interaction with the IBT rules. But that's a lot of us in the room for rules that haven't been around for all that long, particularly, what's that? 15, 17%. 1 in 6 of us have used the new IBT rules since they came into practice. So if you don't have someone in your office who's well-versed in these rules, look around the room. Who's not here? Nominate them because they can't defend themselves and they can learn all these rules and be the firm go-to. Make sure you're confident they can learn those rules.
I gotta also mention, Hugh, I think you did touch this in passing in your discussion, but I think a real risk area is not just our internal clients that we have today, but when we have a new client that walks in, what is part of our client engagement kind of upfront interview? Are we going to ask them, where or how did you acquire the shares for the corporation that I'm going to be doing my corporate work for? Because I think there is the real risk that these IBTs may have been done outside of your view, outside of your scope. And unless you specifically ask for that type of information, it's going to be super easy to miss.
I think we've got to have, and if we don't already have them, maybe we already do, and we're just updating them, some kind of client onboarding model that tells us what steps we take. We mentioned that earlier. And for me, I don't even want to ask the owners what happened in the past.
Yeah.
I want to get in contact with their lawyers, get the minute book, dig through it and see the history, because it's too easy for them to have forgotten something that it isn't important to them. It doesn't really impact the business or the family relationship, but it has a significant income tax impact.
So let's talk about some shareholder loan and benefit issues. We're on page 62. What we had this year that was pretty cool was CRA releasing a couple brand new folios talking about shareholder loan issues as well as deemed interest benefits on these shareholder loans and debt. So we've hyperlinked those tools in your notes. What we've done for the textbook here today is we've scoured through those folios. And I mean, there is just tons of stuff in those folios. So number one, if you do have a shareholder loan question, issue, those two resources would be excellent places to dig through. The other thing, though, we did is we identified some of the issues discussed in these shareholder folios that we think may be particularly relevant to our Mark and our Marsha, our owner-managed clients, and provided that commentary in our notes, or areas where there's higher risk of issues or where we are getting questions. So if we go down to line 15, one of the questions we sometimes get is where Marshark advances a loan to Marsha, and there are specific provisions that if we have advanced the loan for certain purposes, to acquire a dwelling, certain shares of a corporation, motor vehicle, then provided we meet several conditions, that loan would not be taxable in Marsha's hands. One of those conditions is that the loan needs to be advanced to Marsha in her capacity as an employee and not a shareholder. So how do we determine whether that loan was advanced to her as an employee or a shareholder? And CRA includes in those folios several factors that they specifically consider in making that determination. And it's really nice because while we've seen several court cases over the last few years looking at this issue, CRA has summarized the key aspects in their view. So for example, and this is pretty obvious, but on line 22, was that loan that Marshark advanced to Marsha made on the same terms and conditions as a loan, for example, advanced to Nick, the non-shareholder employee? If we're looking at very significant loans, maybe for an automobile, or probably more so for a house or bigger things like that, on line 38, was the loan amount significant relative to the retained earnings of Marshark? If it was significant, that is more indicative of a loan that Marsha receives in her capacity as a shareholder. Likewise, on line 40, if the loan amount was significant, was security provided to the corporation? If no security was provided by Marsha to the lender, Marshark, then yeah, that would be indicative of Marsha receiving the loan in her capacity as a shareholder. So just a couple examples that CRA has in their purview as factors to consider. Now, if we go over to page 63, going down to line 5, a much more common issue, we're looking to avoid a 15-2 shareholder loan income inclusion because we're making sure that Marsha repays that shareholder loan by the end of the following year of Marshark. But we got to make sure that that loan was not a part of a series of loans and repayments to Marsha, the shareholder. Now, CRA does talk about what constitutes a series of loans or repayments of loans, but they do say it's a question of fact. It depends on all the specifics. What I really like about CRA's comments in here is way down on line 21. This is the practical angle here. CRA noted that shareholder loan repayments resulting from applying dividends, salaries, or bonuses, which often happens in the context of our owner-managed businesses, are not considered to be part of a series of loans. And this is the case even where the repayment is followed by additional borrowing. So nice comments from CRA there. And so many of us will have these scenarios where we do have that dividend, we do have that bonus, we clear out the shareholder loan account, and so we do not have a 15-2 income inclusion. We think we're done, right? And the answer is not so quickly. Anytime we have funds advanced to Marsha as a shareholder, one of two things has to happen. Either we've had a 15-2 shareholder loan income inclusion. We really want to avoid that. So once we've avoided that, what is the other consequence? That is a deemed interest benefit under 80.4. You either have a 15-2 income or an 80.4 deemed interest benefit. You're not going to have both. You're not going to have neither. You're going to have one or the other. So it's definitely something that is easy to miss when we're talking about those shareholder loans. Now that's going to take us down to line 25, these back-to-back loan rules. So these are rules that were introduced in 2016. We had a lot of discussion about these rules in 2016, but it hasn't been that hot of a topic to discuss recently. And my concern is that sometimes these arrangements that seem very non-problematic could actually fall into these back-to-back loan rules, and we could have an issue without even recognizing it. So a little bit of a refresher here. When we're talking about 15.2, we're talking about loans advanced from Marshark to Marcia, the shareholder. But what about the instance where we want to avoid a 15.2 income inclusion? So what we do is we have Marshark advanced loans to kind of a third-party intermediary, an entity, on the condition that that entity then advance the loans to Marcia, the individual. So essentially, at the end of the day, Marcia's still getting the money. It's just not coming directly from the corporation. It's being funneled through a third-party intermediary and then over to Marcia. It's those type of situations where we're looking at the back-to-back loan rules. And that could result in a 15.2 income inclusion as well as a deemed interest benefit, like those standard 15.2 issues we've discussed. These provisions on line 30, I meant to, and you can highlight this, capture situations in which the corporation Marshark itself and not that third-party intermediary is the real source of funding to the shareholder. So what we've done is consolidated some comments from professionals, from CRAs, from CRA, pardon me. There's only one CRA and they're quite legendary, not more than one, but comments from a CRA or other practitioners as to when we may inadvertently walk in to the back-to-back loan rules. So for example, on line 40, when finance originally introduced these provisions, they said, you know what, standard guarantees, standard securities provided by Marshark shouldn't typically trigger these back-to-back loan rules. However, on line 40, depending on certain provisions of the corporate guarantees, maybe the guarantees go beyond the amounts that are lent to Marcia, but depending on the certain provisions of the guarantee, we may actually walk into the back-to-back loan rules. Also, on line 41, if we have a bank making a loan to a shareholder and a right to encumber the corporate assets is granted, we may also trigger the back-to-back loan rules if sufficient discretion is provided to the bank to exercise that right. So just because we do have that right granted, it's not in and of itself going to trigger the rules, but it relates to kind of the specific type of right, the specific discretion, the other terms related to the security, the other terms related to the guarantee provided by Marshark. If we want to go down to line 44, where while conventional security shouldn't typically trigger the back-to-back loan rules, we had a specific case that CRA talked about where a corporation acquired a term deposit in the bank, and then that bank subsequently advanced funds to the shareholder in respect of that term deposit. That could trigger the back-to-back loan rules. So when I'm looking at these rules, I'm thinking firm policy. Anytime we have shareholders, Mark and Marcia, getting loans advanced from a third party, from a bank, and Marshark has some type of role in the individuals getting that loan, we need to just take a double check. Could we fall offside of the back-to-back loan rules? We actually have Ali, thank you, popping an additional resource into the public chat, providing a bit more commentary on this type of issue where we have corporate guarantees being provided for Marcia's personal loans from the banks. Now, if we go on to line 7 here, okay, so more standard shareholder loan income inclusion rules. How does it look if we do have to report an income inclusion under 15.2. And so, as we've discussed, whenever we have loans advanced to Mark and Marcia from Marshark, one of two things happen. You have 15.2 or you have an 80.4 sub 2 benefit. So what about the situation on line 18? Which is more typically the case. Mark and Marcia borrow funds from Marshark, but they think they're going to repay it by the end of the following fiscal period. So they do not report that loan in their income in the first year. Something happens, cash flow crisis, whatever. They can't repay the loan by the end of the fiscal year. What happens in that case? Well, number one, in that first year, Mark and Marcia should have reported a deemed interest benefit. So in that second year, when they go and adjust the first year to include the 15.2 income inclusion in that first year's tax return, they will back out that deemed interest benefit in that first year. And then we have the reverse situation on line 12, probably much more rare in practice. But what if in year one, we reported a 15.2 an income inclusion on a 15.2 shareholder loan, but then we do get to back it out because we had the cash to repay it by the end of the following fiscal year. Well, then you adjust that first year's return, pull out that 15.2 income inclusion. And then obviously you do have the deemed interest benefit that should be reported in that first year. Now, if we go down, and if you want to highlight anything, I really like lines 25 through lines 27 that really underscore the concept between the fact that you either have 15.2 or 80.4. You're not going to have both. You're not going to have neither. It's one or the other. And I think it's really easy to miss this because it hasn't really been a big issue in our practice. I haven't seen CRA really digging after this deemed interest benefit, particularly where the interest rates were low for so many years. We start to see them tick up and then come back down, but it is the way the Tax Act works. Now, I did also want to just bring on to the screen Dean Blatchford. He's a tax lawyer in Ottawa. And I asked him, okay, Dean, what's going on in your practice? What do you think practitioners across the country need to know about, need to be thinking about as they kind of carry on with their practices? And he mentioned that he's seeing lots of issues related to disputes tied to the shareholder loan account. So we've got Dean on the screen. He has a 5-minute and 14-second video clip talking about these issues from Blatchford Tax Law.
I know one thing for sure about everyone who's watching this video right now, and that's that you care deeply about your client's financial well-being and their accounting compliance. And I know that because you signed up for 2 full days of dad jokes from Joe Devaney. Now, knowing that you care that much about your clients, I also know that you would want to know the number one reason that I see large tax disputes end up as on my desk as a tax dispute resolution lawyer. And that is poor shareholder loan account management. So what I'm going to be talking to you today about is a concept that I call shareholder loan account hygiene. Now, I'm not talking about big loans from the shareholder from the corporation to the shareholder, where there's a loan agreement and there's an interest rate, because I know that you know those rules and that you would follow them and dot all your I's and cross all your T's. What I'm more concerned about is the everyday transactions, the intermingling between the corporate and the shareholder accounts, and the end of year adjustment entries, the netting out adjustment entries, where there's money going from the corporation to the shareholder, but there's also money going from the shareholder to the corporation. And so instead of having individualized entries, we just have one netting out entry that kind of takes care of it all. In order to explain this concept of shareholder loan account hygiene, I'm going to be referring to 3 quotes that I heard from CPAs and accountants within the last year. And the first quote came from a young accountant, and he said, "Why should we care about money going in? Our job is to be on top of the money coming out. And of course, he's right that the money coming out is very important because that triggers an immediate tax consequence. When money's coming out of the corporation, we need to record it as either a dividend, salary, or reduction in that shareholder loan account. But what this young CPA wasn't realizing was that with the mere stroke of a few keys, we are creating tax-free money if we're putting in money to the shareholder loan account. And the next year or the year after that or the year after that, when the shareholder takes that money out, if they can't prove that they had loaned the money, CRA can audit them and then just deny that reduction, deny that as a tax-free withdrawal. And now the shareholder gets hit under 15 sub 1 for taxable income. They could also lead to other things like a net worth audit, etc. So just as critical as it is to track the money going out, it is also critical to track and support the money going in. The next quote came from a client of mine, and this was a very successful business owner. He had put almost $2 million invested in his corporation, and the corporation had become very successful over the course of about 15 years. And so after it had become successful, he capitalized his shareholder loan to the corporation. It became part of his ACB. And so when he's selling the corporation, of course, that ACB gets deducted from his gain. The problem was that he hadn't kept documentation to support the money going in, the money that he had loaned to the corporation all those years ago. And so CRA audited him, and he said to me, wait, how can I be expected to prove a transaction that took place 14 years ago? And that's the problem, is the shareholder loan account kind of creates a skeleton in your closet. So even though the limitation period might be 3 or 4 years on an audit, if you have a shareholder loan account entry that you're relying on in order to get tax-free money, then you need to be able to prove that transaction many years in the future. That requires really detailed entries. It requires not using netting out entries, and it requires supporting documentation as well. The last quote I want to give you is from a very sharp CPA, and she said to me, I view shareholder loan accounts as a dumping ground. When I take on a new client, the first thing I do is look at their shareholder loan account to see whether it's active and see how detailed it is. The state of their shareholder loan account determines whether I'm willing to take on a client, and affects the quote that I give them for my services. And so I'm going to make that recommendation to you. First, don't let a shareholder loan account that's under your watch become a dumping ground. Make sure your clients know that they need to give you the information you need and the supporting documentation you need to keep that shareholder loan account sparkling clean. And if you do have a client who's not giving you that information, or you have someone coming to you that wants you to take on their file and they have a dumping ground for a shareholder loan account, I ask you, should they be receiving the same quote for your services as someone who comes to you with pearly whites?
Thanks, Dean. Some great tips in there. They're going to flip over. Continuing on with some shareholder loan issues, let's talk about our hygiene. Page 65, going down to line 34. This is a court case, just a great reminder that we got to get our shareholder loan account hygiene into check. In this case, the corporation had kind of put a lot of stuff into their shareholder loan dumping ground. Of course, they did have amounts owing to the shareholder, Marsha, but they did include all sorts of other types of amounts in there, amounts owed to other corporations. And as CRA were looking in this shareholder loan account, they assessed the whole outstanding shareholder loan account as a shareholder benefit. Eventually, in the courts, we were able to reverse that assessment. But I think if we could have had a squeaky clean shareholder loan account, we wouldn't have had to waste all our time, money, stress, going all the way through to the tax courts to get that result. If we go over to page 66, if we go to line 10, another court case where if our records aren't good, we're going to create problems. And I look at this one, I think, oh yeah, I could totally see this happening. In this case, we're looking at both shareholder benefits, the indirect payments provisions, as well as gross negligence penalties. So think about this on line 23, far right. We have Marcia advancing funds into the corporation for years and years and years. And she'd advanced over $500,000, $600,000 into the corporation, but she didn't keep great records. Now, the problem is when the corporation made payments to Marcia, Marcia thought, okay, this is no problem. It's just a return of my advance to the shareholder. But the problem here is that the bookkeeping was not clean. The transactions were not properly recorded. And at the end of the day, the taxpayer loses on line 30. Those amounts repaid, or the amounts paid to Marcia, the shareholder, were found to be shareholder benefits. On line 34, the amount that Marcia received from the corporation were not recorded via debit to the shareholder loan account. They were not recorded as a repayment of her shareholder loan. As such, that is a full taxable benefit. What seems like a small or minor error creates incredible tax cost for Marcia. Now, if we go down to line 42, the corporation also paid for some of the expenditures of Marcia's adult child. And the CRA chose to deal with this corporation taking on some of the expenditures of the adult child by looking at whether we have an indirect payment under 56 sub 2 such that we would have a benefit in Marcia's hands. Now, when we're looking at 56 sub 2 and that benefit to Marcia, we need to satisfy several conditions in order for that income assessed to be upheld. So if we go to page 67 on line 1, that payment from Marshark must be made to a person other than Marcia, the reassessed taxpayer. The allocations were made at the direction or with the concurrence of the reassessed taxpayer. Marcia said, yes, Marshark, go pay for Minnie's mortgage payments. Go pay Minnie's creditors. On line 4, the payments were made for the benefit of either Marcia or someone who Marcia wanted to benefit. Yeah, you want to benefit your daughter. We satisfy that condition. And on line 6, the payments would have been included in Marcia's income if she had received the amounts. So yes, that would have been a full income inclusion to Marcia. That means this 56 sub 2 indirect payment income inclusion was upheld. Now, a bit of a win for the taxpayer while we're dealing with significant 15 or shareholder benefits here. We're dealing with significant indirect income or indirect payments assessed as income on Marcia's return. The gross negligence penalties that CRA assessed did not stick. The court found that Marcia, the corporation, was not grossly negligent. CRA had took the position that Marcia, about on line 14, 40 years earlier, did take I think it was a personal tax preparation course, and therefore she should have known how to deal with corporate accounting, corporate tax. And at the end of the day, the court said, no, just because you did a T1 course 40 years ago doesn't mean you're a tax, or doesn't mean you should have all the skills of a corporate tax expert and specialist. So those gross negligence penalties were not applicable. That's going to take us down to line 17. Okay, we all have the Marcias who decide, okay, we're just going to have these corporate assets. We're just going to write it all off in the corporation. I don't need to worry about it. I got a corporation. I'm good to go. Push it all through there, claim the deductions. In this case, we had a tire distribution business in Quebec, and we had several luxury vehicles on line 20 within the corporation. We had $300,000 of deductions associated with those luxury vehicles in our corporation. So first of all, we're looking at whether we get a deduction in the corporation. We're also looking at taxable benefits being assessed on Marsha personally as the shareholder. So first of all, was there a business reason, an income earning purpose, an income earning reason for having those fancy cars in the corporation such that we could get $300K of corporate deductions? Line 25. No, the taxpayer loses. The taxpayer here argued, okay, I'm in the tire distribution business. I need credibility in the market. I need these fancy cars for brand promotion purposes, to connect with clients, for, advertising. And while at first blush the story may make sense, the taxpayer did not have evidence to substantiate their position. The taxpayer said, we use these fancy cars for a ride and drive event. However, they were only able to provide evidence for one ride and drive event where one customer was in the vehicle for that ride and drive event. If you do have these positions, you gotta have the support for them. Now, I think the scarier aspect here is on line 37, related to the taxable shareholder benefit. The court noted that several of these very fancy vehicles, Lamborghinis, Corvettes, Ferraris, were made continuously available to the shareholder. And as such, the full standby charge applied. And when we're looking at the full standby charge, it's based on the cost of the acquisition or the acquisition cost of that vehicle. So even if those vehicles appreciate pretty significantly over the years, the standby charge for all the years is still based on the original acquisition cost. And that's a pretty big number when we're dealing with these expensive vehicles. The court noted on line 42 that no logs were provided to establish that they did not have access to the fancy vehicles at all times. There was no evidence to support they did not have that constant access to those vehicles. And even on line 45, some of the vehicles were transported to the taxpayer's personal residence in Florida. At the end of the day, we had a huge taxable standby charge of over $1 million, $640,000 assessed on Marsha personally. Wanted to mention one other item. I mean, it's not as big of a dollar value, but it's a question that we see happen sometimes. And on line one, what we had here was Marshark selling one of the cars to Marsha personally. They sold the vehicle to Marsha personally for $12,000. And then just a few months later, on line 276 days later, Marsha sold that vehicle to a third party for $150,000. So really, did she get a benefit when she acquired that property for less than fair market value from the corporation? And the corp said, yeah, we do have a benefit attributable to Marsha in respect of acquiring that corporate asset at less than fair market value. Now, we've already talked about the shareholder benefit. We've talked about the denied corporate deduction. Can it get worse? And I think this aspect on line 7 is the one that really got me to wake up and take notice. It's the gross negligence penalties. So first of all, with respect to the corporate deductions, the court said, you know what? While I didn't agree with your position for deducting those corporate expenditures, I didn't think it was so outrageous to deduct the amount. So gross negligence penalties dismissed on the corporate deduction side. However, the court upheld the gross negligence penalty on that $640,000 shareholder benefit. So if we just take a step back and do the numbers right now, we're talking about $640K income inclusion, say at the top rate in Ontario, 53.53%. We're talking about $340,000 just in tax, plus gross negligence penalties at 50% of that 341. So we're talking at over $500,000 just tax and penalties. We're not even considering interest on this bill because we had those fancy vehicles in the corporation available at all time to Marcia. A pretty expensive cost for that arrangement that Marcia had entered into. So that got us thinking, okay, is CRA questioning the personal use of business assets? So let's pop this up on the screen, Paola. We're looking at a 2-year look back window. Have you seen CRA question the personal use of a business asset? And yeah, we're seeing questions. 42% yes, 55% no, and a couple percentage points not applicable. So if you're getting pushback from Marcia related to her personal use of a corporate asset, give them these stats from a course that you just went to. Nearly half of the practitioners, or 42% of the practitioners, have actually seen CRA asking about the use of these corporate assets. Now that, and actually, you know what? One other thing, my other takeaway here, this is a firm policy note. When we do have a position that may seem a bit aggressive, but at least we've thought about the position, I'm thinking about on the corporate deduction side, we probably want to document our position in the file because we had a reasonable basis for deducting the vehicle expenses in the corporation. While we lost the deduction, we did not get hit with gross negligence penalties. So that was helpful, but we didn't have a basis for the shareholder benefits. But at least, by having some type of documentation in the file, we can hopefully avoid those really nasty gross negligence penalties in some of those cases.
Kate, I find that documentation is useful a lot more often than we might expect it to be. Even being able, when the auditor is there, and if you've got the auditor coming into your office or you're answering the auditor's questions, being able to go to your file and say, look, this is what we did at the time.
Yeah.
Is typically received a lot better than, let me get back to you in a couple of days when I've had a chance to think about why we might be able to argue that.
Yeah. And even just having the confidence to know while you talk to the auditor, yes, there was a reasonable basis for doing it. I have it in my file. Very helpful.
Sometimes just in the course of papering that up, you realize, okay, Marcia, put these documents aside and don't lose them because you may need them years down the road. Or, oh, for that reason, okay, that's another good reason that it's deductible.
Mm-hmm.
Understanding the whole story makes a lot of difference.
We're going to carry on to page 70, going down to line 20. Another situation here, FMB have transferred real estate. So what we had here was Marshark. They had a piece of real estate. They couldn't offload it, but they eventually sold it to Nick, the non-shareholder employee, on line 24 for $350,000. Just over a year later, Nick subsequently sold that piece of real estate to a third party, and holy smokes, he made bank on line 25. He sold it for $1.3 million. So you can understand why the tax authorities were wondering about this transaction. Did Nick actually acquire the real estate at fair market value? The CRA here, tax authorities here, said no. They said, we think the fair market value of that property that Nick got from the corporation was $1.3 million. And that led to a whole bunch of assessments. If you go down to line 36, the tax authority assessed Marshark with a corporate capital gain. They assessed Marshark with sales tax on that full $1.3 million. They assessed a shareholder benefit on the difference between the $350,000 and the $1.3 million. And Nick, not to be left out here, was also assessed with an employee benefit of the difference between the purchase price and the sale price of $1.3 million. So at the end of the day, the real question was, okay, what is the fair market value of that real estate that was transferred? If we go to page 71, going down to line 1, first of all, neither party, neither the taxpayer nor the tax authorities brought any appraisals or expert witnesses. So what the court did say is, okay, we are going to use the municipal assessment of on line 5, 562,600 as the fair market value of the property. And it also noted that the third party purchaser, they were a special purchaser. They had kind of their own very specific reasons for why they would pay higher than fair market value for those assets. In fact, that third party buyer really, really wanted this parcel of land because they were going to attach that parcel they're buying with other existing land they held to build or to develop on line 7 a $20 million real estate project. So the fact that that subsequent buyer had that special interest in the land does not retroactively kind of impact the fair market value of the property when Nick acquired the property from Marshark. So definite helpful comments there. Now we go down on line 15. Who was arm's length? Who was not arm's length in this whole mess of transactions with respect to corporation and Nick, the employee? They were found not to be acting at arm's length. However, the shareholder who was thinking, what the heck? I have a big shareholder benefit because of something Nick got? Are you kidding me? Well, the court found that that shareholder, Marcia, and Nick were acting at arm's length. So there was no taxable shareholder benefit there. At the end of the day, on line 29, that corporate capital gain was reduced to 562, no shareholder income inclusion. The question that some of you might be thinking is, okay, what about Nick, the non-shareholder employee? We know he got hit with a taxable benefit. It's important to note that Nick was not a party to the appeal. So it looks like Nick either didn't object or for whatever reason didn't become part of the appeal. And as such, Nick doesn't get to benefit from the court's ruling in significantly reducing his employee, taxable benefit. So a caution there. I mean, how brutal could that be if you were Nick or even Mark and Marcia tried to keep one of your key employees very happy and they get hit with this huge taxable benefit that if they would have just been part of the appeal, that would have got wiped down or significantly reduced. So a quick little firm policy, when we are objecting to our assessments, are all the relevant parties properly objecting? And if not, have we communicated the risks of not objecting for each and every relevant taxpayer? Now that's going to take us down to line 41, Tosi Tango, the tax on split income. We know that if Marcia gets a taxable dividend from Marshark, there is the risk that that dividend can be subject to the top marginal tax rate unless we meet one of several exceptions from top rate taxation. This article here focuses on page 72 on line 2, the excluded share exception. So this is the exception where, let's not talk about Marcia, let's talk about the kid. One of the kids that are 25 plus. Yeah, Minnie's 25 plus. She has excluded shares, so she has at least 10% of the votes and values of Marshark. We know Marshark is not a professional corporation; it's not a service business. So we meet all the conditions to have an excluded share, so that any dividends coming up to Minnie would be at the marginal tax rates. But what happens if, for whatever reason, Minnie grants power of attorney of her affairs, including those shares on which we got the excluded share exception, to her father? or her mother or some other party, does that impact her access to the excluded share exception? And in this technical interpretation, CRA says no. On line 10, they confirmed that a power of attorney does not transfer legal or beneficial ownership. And as such, on line 12, Minnie remained the legal and beneficial owner and remained having access to that excluded share exception. So a little bit of good news there if ever you've dealt with that issue. Going down to line 16, we had a couple proposals to ever so slightly broaden the inherited property exception as well as the relationship breakdown exception. Those proposed broadenings were included in the August 2024 package of draft legislation. We talked about that change last year, so we're not going to talk about it again, but just note it is still outstanding, proposed to be retroactive to 2024. We're going to go over to page 75, looking at the issue of salaries versus draws. Pretty common issue here. In this case, we had CRA assess that the amounts paid to the shareholders were salaries. Taxpayer said, no, they are draws. And CRA, on the basis that they thought they were salaries, you should have withheld income tax as well as CPP. So what are we looking at here on lines 11 through lines 13? We have a few years of payments that went out. The payments that went out were kind of oddball amounts. They weren't round numbers for the shareholder draw. So it kind of did look like there may have been some withholdings on them. The bookkeeper also noted on the payments out to the shareholder that added the word payroll on these checks. So obviously, if you're a CRA auditor and you're looking at checks that say payroll on them, you can understand why they thought with these oddball amounts, these amounts would have been a salary. Also, the court noted that there were payroll remittances actually made in respect to these payments for the first couple months of the period at issue. So you know where CRA is coming at. However, when we actually go to court on line 17 and 18, we found that the court found that both the accountant and Mark and Marcia, the shareholders, were credible witnesses. They found that number one, the remittances made in the first couple months, those were remittances made in error. So that did not taint the whole mess to be considered shareholders. So a little bit of an error here by the taxpayer created a big problem when they're dealing with the tax authorities and the salary assessment. But at the end of the day, line 20, the shareholders' accountants, they were credible. They were able to explain to the court how they intended to receive dividends. They didn't want the cash flow issue that comes from the required withholdings on the salaries being paid to Mark and Marcia. The problem with tracking and noting information on line 23, the bookkeeper didn't have the sufficient training and they didn't think they were creating an issue by noting payroll and the checks to Mark and Marcia. They were just thought they were kind of being clear and differentiating which checks were going to the shareholders and which checks were going to the other staff in respect of filing. The court noted that the financial statements and the tax returns were consistent with the taxpayer position that these were shareholder draws. At the end of the day, the court found, yes, that these were shareholder draws. But I think another really important reminder that we got to keep our hygiene in check. If we would have had a much cleaner kind of back end accounting for the taxpayer, it probably would have raised a lot fewer red flags for the tax authority. So make sure to brush and floss your teeth every day, particularly when you're doing the bookkeeping, or get someone else to floss your corporate teeth. If we go down, I've never used that before. I think I might floss your corporate teeth. Going down to thank you for calling me out, Joe. I deserve that. Going down to line 36 here. Final item in the owner-manager section, late source deductions, annual remuneration. So we had a taxpayer here who didn't want to do source deductions throughout the year. So what they did is they just waited till the end of the year, had one big salary payment, one big source deduction. And unfortunately for them, they also got one big penalty in respect of providing those source deductions late. Now, we were more than 7 days late, so we were dealing with a 10% penalty. This was a Quebec case, but the same concept applies under for the rest of us outside of Quebec under the federal system. So what do we have here on line 70 or page 76 on line 1 here? As noted, we had our annual remuneration at the end of the year. We had our annual source deductions. In prior years, we were a monthly remitter. So we knew that if we had the payment in December, we needed to get the source deductions in by the 15th of January. And that's what we did. The 15th in this year was actually a Saturday. So we made sure to get the source deductions in by Monday, January 17th. We thought everything was tickety-boo. Unfortunately, because we had significant source deductions in the last few years, we were transitioned from a monthly remitter to a weekly remitter. And as a weekly remitter, we needed to get those source deductions in by the 3rd of January, which led to this very significant penalty for the taxpayer. So what did the court say? And they agreed with the tax authorities. They said, okay, if you only make your one source deduction payment, that one source deduction payment going down to line 26, that is your average monthly payment. So if you had over that 100K threshold in your source deduction, that is enough to transition you back to or transition you to a weekly remitter. The court also said that it was your decision to make those big lump sum remuneration payments. It was your decision to pay the remuneration late in the year. It is your responsibility to pay this withholding penalty. Too bad, so sad. As a firm policy, maybe something we can learn from this is that where we do have clients that like to do the annual remuneration, annual source deduction payment, maybe if we want to get back and get those monthly remittances back to that lower number, maybe as a firm policy, we want to make more regular, even if they're just smaller remittances throughout the year, so we can deduct that remuneration or that annual source deduction payment over that 12-month period. The court also noted, or the taxpayer also argued, that the payroll guide said that CRA or the authorities would notify you once you went from monthly to weekly. The taxpayer was not notified, and the court just said, too bad, so sad. That's all administrative. It doesn't matter. The law is what the law is. You have that $36,000 penalty that you need to take care of.
We're going over to HST land on this tax extravaganza. So the first thing that we're going to talk about is on page 79, line 6, sale of newly constructed property. So we're talking about an individual here who might have bought a piece of land, fixed it up a little bit, sold it. Were they supposed to charge, collect, remit HST on that disposition or production of the property? The answer is it depends, but I really like this case here because it walks through the different provisions that would make that sale exempt. So we can start off by going to, and by the way, this was a set of siblings who had done this, bought it and built it up and lived in it a little bit and sold it. First option is on line 28. Was it a sale by a person who was not a builder? Not a builder. What can I do to make myself not a builder? Well, you got to look at whether line 33, the owner occupied the property This would provide support that the property was acquired for personal use and not as a business or adventure in the nature of trade. Because that last little phrase there, business or adventure in the nature of trade, if you're doing it for those reasons, then you are likely going to be a builder. That's sort of like one of the conditions to be a builder. So that's the first thing. Are you living in it? That's the indication of personal purpose. Line 36, the builder used the property as a residence. So if it was done primarily for use as a residence of the builder or the builder's relative, that would be an out. So as you can see, sort of like these first two options are really tied with sort of residential use of that property, or personal use of that property. Page 80, line 1, the third option is where the property was previous self-supplied. Now, that doesn't really help us out, because what that means is we would have had to self-supply and self-assess in the past, and then we would have missed that one in this case. So that's not one we're really going to pursue here. So on line 12, the taxpayers actually did win. Why? Line 14, on a balance of probabilities, the courts did believe that the siblings occupied the property as a residence, therefore supporting both of those first two arguments. How did they support that? Go to line 19. They purchased new furniture, bedroom sets, etc., that were actually delivered to the property. So when you can have that invoice from a third party saying this is what was bought and this is specifically where it was delivered to, that is a helpful thing. Going to line 22, and to me, from what I've seen in all these cases, this is the biggest thing. We had periodic invoices showing the use of electricity and gas services. You got a bunch of electrical use, you got a bunch of gas use. I mean, you're probably living there. Electricity, I mean, your computers, your phones, your lights, all that kind of stuff. Gas to keep you warm. Those are pretty big indicators. One of the things that the court did say, though, was on line 27, the fact that they didn't have a cable bill or an internet bill or phone services, that's not essential. Why is it? Because you can get all those three things by just a cell phone these days. Unlimited data plans or very high data plans don't necessarily need these kind of things, not an indication that you did or didn't live there. So just a couple points there, and at the end of the day, the taxpayers did win. The next thing on line 35, here's a technical interpretation just discussing whether this taxpayer was a builder or not. The first thing you want to do, maybe just highlight this, go to line 44. When an individual sells an interest in a residential complex before or during construction, so these, assignment sale situations, it is generally considered evidence of a business transaction. So to argue that it was something other than a business transaction or adventure in the nature of trade is going to be difficult. But if it was going to be argued, what would CRA want to see? Go to page 81. We've got to go to line 1. You must support the asserted primary purpose as a personal use property. This means that the non-business primary purpose for which the taxpayer acquired the property must be accompanied by, and here are the keywords to highlight, a firm, fixed, and settled intention that was not likely to change. In other words, the intention for non-business use cannot have been tentative, provisional, or exploratory contemplation, etc. So when I think about this, and this wasn't said in this technical interpretation, I can't be saying things like, I was intending to move there in case I got a job, which wasn't certain at the time. Like those provisional types of things, that would be problematic according to CRA. Going on to line 9, whether the taxpayer was builder. Here's another court case that discusses this, some other key points. So just go to line 26. This is a good highlight. The court noted that a single acquisition and disposition of property could qualify as an adventure in the nature of trade. So, just because it's a single thing doesn't mean you're off the hook. I mean, it's an argument that, you're not familiar with this type of thing and maybe it isn't a business, but that's not enough in and of itself. Also, go to line 36. You might want to highlight this. The court stated that the taxpayer had no experience building houses or balancing coexisting possibilities of living in a house or selling it for a profit. Go to line 38. Neither the lack of experience nor any possible missteps would prevent it from being an adventure in the nature of trade. Going over to page 82, line 3. This is one that we see come up all the time. Financing. How did you pay for this property? And just in its simplest form here, if you paid for it in a way that indicated that it wasn't a long-term investment, that's going to be problematic. So if you take out a mortgage that is really high rate or interest only or easy to cancel, those are indications that you're only going to be holding it short term. But if you're locked in and if there's penalties associated with it, with cancellation of it, those are indications that it's more long-term and personal sort of in nature, or at least you're not going to be flipping it quickly. So that's basically what line 3 through 6 says here. The other part that I found humorous, I guess, is on line 8, moving personal belongings. So we indicated earlier that moving personal belongings or filling it up with furniture is a good thing. It indicates a personal use or personal intention. But in this case here, they had already sold the property. And once it was signed, then they moved their personal things in. So you could see that maybe they were trying to make an argument that this wasn't a business sale, that this was a personal type of thing. But the thing is, if you're doing that after the fact, that's not going to help you out. And the courts pointed that out. So that's all I wanted to say about that. We're going to go down to on line 27 in the notes, talk about the first-time home buyers GST rebate. Now, the first thing you want to do here, and maybe you write it on the page, is write down no royal assent received yet. This is just in bill form. It's not actually law. But the effective date was from a few months ago, basically May 27th. And we'll get into the dates in a moment here. So this is something we want to watch out for, because once it passes, then we'll be able to apply, and we've got to take note of what we have done in the past because it might be eligible for this. So what are we talking about here? This rebate is basically line 32 or 31, GST relief on the purchase of new homes valued up to $1.5 million. So the federal portion of your HST, new homes, and you know what, we have seen some relief on the provincial side as well, but that's not the point of what we're talking about here. So how it works is basically on line 38, 100% GST rebate on the values of up to $1 million. As you get to the 1.5 million, so that gap between 1 and 1.5 million, you basically prorate out the rebate. So if you're halfway there, if you're at 1.25 million, that's 50% of the way up to 1.5. You basically get 50% of the rebate on that first $1 million of value. So that's how that works. On line 42, we've got details on your eligible acquisitions. This is basically the same criteria as the conditions for the existing GST, HST new housing rebate. So the same types of properties. Page 83, line 2, you gotta be a first-time home buyer. So there's a couple conditions there, but I think the main thing is the test about being a first-time home buyer is it's the same test as being eligible for the home buyers plan. So, and there's a few other situations where, we try to identify who is a first-time home buyer. It's really very similar criteria. Line 16, the acquisition date. Line 19, this purchase agreement that you enter into had to have entered into, line 19, between May 27th, 2025 to December 31st, 2030. So basically like a 5-year span, you've got to have signed this agreement in. It's not just for ones that you have bought from a third party, though. It could be an owner-built home. Now, the real question is, when it's an owner-built home, go to line 20, the construction must begin no earlier than May 27th of 2025. Now, there are a couple cautions here. On line 23, limitations, line 26. You can't have previously claimed one of these rebates. If on line 27, it was acquired pursuant to an assignment sale, you don't look at the point in which it was assigned to you, that right was assigned to you. You look at the original agreement that other party had actually signed. When did that occur? Was that before this date? You're out of luck. The other thing that we need to watch out for is on line 29, if you actually did sign one of these agreements and it was before May 27, 2025, but then you cancel it, and then there's a replacement agreement that's after that date. I mean, I know some friends that would try that kind of thing. I'm sure we all have friends like that. There are anti-avoidance provisions that would catch you in those situations as well. Page 89, taking a look at line 18, purpose-built rental housing rebate. Okay, so we're talking about this newish initiative started in 2023 where you can get an enhanced rental, a new rental rebate. So we've got the details here. We've talked about it in the past, but now we're starting to get CRA chiming in and giving their 2 cents on interpretation of the law. So let's take a look at a couple things that they have to say. But to get into that, there are a couple pieces of the basics we just need to quickly, touch back on. So page 89, line 37, don't forget, for units within a newly acquired or self-supplied MERC, so a multiple unit residential complex. So you're getting the whole thing. It's got to have at least on line 42, 4 or more residential units that each contain their own private kitchen, facility, bath, or living area. So more complete type of a living situation, or it's got to contain at least 10 residential units. So like a bedroom with a lock, and then you have some shared areas. So it's got to have one of those two. On line or page 90, don't forget that line 4, where the units are in addition to an existing MERC. So you've already got a number of units, and now you're adding sort of like another wing to it, something like that. The addition itself has to meet that 4-unit test or 10 sort of smaller unit test. And also on line 12, 90% of the addition must be designated for long-term rental use, and at least 90% of the units of the MERC as a whole, not just the addition, must be for long-term rental. So a couple things there to note. Now let's take a look at CRA's interpretation, line 35. What about strata titled townhomes? So here we had the construction of 2 buildings, so side by side, but separated, a little piece of grass for dogs to run through, whatever, 4 units in each one. So now we want to get them strata titled, so separated legal documentation and ownership here. Are you going to be able to get it? And the court, or not the court, but CRA says it depends on exactly how far down you stratify it. If you go over to page 91, line 1, if each unit was strata titled, so now you have basically 8 units, those would now be considered essentially condominiums in a condominium complex, and you're not eligible for this new housing rebate. However, if you just divided it into buildings, so one title for each of the buildings, now it's not a condominium complex. It's one thing with 4 units in it. You meet the test of having at least 4 units. You could be eligible at that point. What if on line 8, you're building 2 duplexes? So, 2 buildings, but there are 2 units in each of them. Are you caught or not? Do you have an argument here? And the position from CRA was probably not. You probably have 2 separate units that each have 2 units in it. So you'd probably not get it. But if on line 19, they were connected by a hallway, now we have something that may constitute a single building, but it's a question of fact. Do we have essentially one integrated system that feeds both of them? For example, heating, cooling, those types of things. If they're more fully integrated, then that would be one building that has 4 units rather than 2 buildings that have 2 units, which wouldn't be enough to qualify. So there's a couple comments there. Nothing else I want to mention for this topic. That's going to take us over to the next page, though. And Caitlin.
Yes, we're going to line 27. We're on page 92, shifting gears into some more filing administration issues. Now, Grandpa Mort, he passed away earlier this year. Prior to his passing, he, however, was a proprietor. He was registered for HST. And so when he did pass away, according to the existing provisions of the Excise Tax Act, we needed to get his HST return for that period that ended on his death. We needed to get that in within 1 month after his passing. So obviously, very difficult to do in such a timely manner. Well, what we have here is a proposal contained within on line 31 that August 2025 package of draft legislation, which basically would say we have a 6-month period after Grandpa Mort's passing to get in that HST return. So hasn't received royal assent, but definitely movement in the right direction so we can focus on Grandma Mimi and all of the other things that come around after the passing of Grandpa Mort. Now that's going to take us down to line 37. Interestingly, in the summer of 2024, we had legislative changes that kind of loosened up some of the requirements for retaining some documentation in respect of claiming input tax credits. This change was effective retroactive to 2021. So, it's should have been in effect for a long time, but we've just started noticing CRA coming out more recently with more and more commentary reminding us of these new rules. So if you're not aware of this kind of slight loosening up, take a look at the chart on page 94 that the CRA has published because it might help you as you're dealing with training your clients, training your Marsharks on proper documents for getting those input tax credits. So when we get those RIP audits, we're not going to create or run into problems. If we go to line 33, let's talk about Marshark, our dentist or our orthodontist. And what we had for several years was an administrative policy that each and every quarter, the dentist could estimate the portion of their consideration that related to exempt medical services, the orthopedic services, and the portion of their consideration that they received that related to taxable services. So the orthodontic appliance or whatever the case may be, you estimate it as long as the portion of the taxable supplies doesn't exceed that 35%. CRA was happy with the estimate. And then at the end of the fiscal year, you just true up your estimate to your actual amounts you received based on taxable or exempt supply in respect of claiming input tax credits. Well, we recently had a court case that says, no, that we cannot have that administrative position. So CRA has gone out there and said, we are revoking that administrative position, which allowed these dental practitioners to estimate essentially their ITCs for each reporting period and then true it up at the end of the year. So they can no longer do those estimates. Page 95, going down to line 5. As of the 1st of January of this year, we need to determine the actual HST that we can be claiming back for each and every period. So we're going to get the same amount of HST as an input tax credit under kind of 2025 and later rules. We just have to measure it on that accurate ongoing basis. No more estimates throughout the year. I have a firm policy and FP note here. I want to follow up with all my dental clients to make sure they have updated their internal policies if they do their own GST, HST filings to make sure they are properly claiming their input tax credits. If we go down to line 29, once again, we have a court case looking at the one or multiple supplies issue. I really like this court case because I think it could have broader ramifications than just the taxpayer scenario here. So what we're dealing with here is MedSleep Inc. That's a incorporated entity that works with physicians, sleep physicians, to provide kind of diagnostic sleep services to individuals, to you and I. So you might think about this as Marcia, whomever is dealing with insomnia, some sleep issues. They go to this clinic, they sleep at the clinic, and the physicians kind of look at what's going on in the taxpayers, whatever, and help them with their sleep, issues. So at the end of the day, the court was looking at whether the taxpayer was providing a single exempt supply with the physician of exempt medical services, or was the corporation here on line 32 making a taxable supply of basically administrative and other support services to the physician? Should they have been charging HST on the supplies being made to the physician? So at the end of the day, the court looked at all the details. They looked at the kind of the substance of the transaction, the reality of the transaction, the reality of what the patients were wanting when they came into the sleep clinic. And they found that we had a single supply of exempt medical services. The taxpayer won on line 39. The services provided by the corporation and the services provided by the sleep physicians were just so interdependent, so connected. Those services could not stand alone, such that they constituted that single exempt supply. I mean, if you're looking at line 41 here, the clinic, the corporation providing the pillow on which you rest your head to do your sleep assessment. You can't charge separately for that pillow. You can't charge separately for the heat or the light that the corporation was providing in their role as the taxpayer here. Those services were too connected. It's that single exempt supply. And then I'm looking down at line 45. The taxpayer here had this revenue sharing arrangement. And the court said, yes, it was a legitimate fee sharing arrangement rather than a payment for services. So when I'm thinking about the MedSleep case, I'm thinking about the other medical practitioners that I have in my client base that are also using this fee sharing arrangement, that also may have these HST issues that are coming up. And I'm thinking, okay, cool, this MedSleep case may provide us with good guidance. Now that's going to take us over to page 103, going down to line 8. Mark and Marcia, they have an Airbnb that they're renting. And we know, going back to line 13, 2021, HST began to be applied on all of these short-term rentals accommodations that are operated through a digital platform. Now, the whole concept here is that on line 18 through line 21, if Mark and Marcia were not registered for HST, then the online platform, the VRBO, the Airbnb, whatever the case may be, would collect HST on their behalf and remit it to the CRA. If, however, Mark and Marcia were registered for HST, then it was incumbent legislatively on Mark and Marcia to collect HST and remit it to the CRA. However, that was not happening in practice. And we got this feedback actually in these courses a couple of years ago, where Airbnb was just collecting HST for everybody and remitting HST for everybody, regardless of whether Mark and Marcia were a registrant or not. So there was a lot of concern out there. If Mark and Marcia is a registrant, do I have to remit HST again? That's not fair. That doesn't make sense. Well, you can go down to line 29 here, and CRA commented on this matter and came out with, I think, the reasonable response that they don't intend to collect tax twice. So if the platform operator is already doing it, Mark and Marcia do not also need to collect HST. So rarely do we get to pull up the woohoo sign, but now is the moment. Sanity prevails. Woohoo.
Hello, everyone. So I wanted to chat a bit about the streamlined GST and HST regulations. You should have in front of you a bit of a quick reference sheet that I put together for you and some examples that we'll go over. You may already be familiar with these regulations. It's generally called the quick method. It stems from section 227 of the Excise Tax Act, and you elect to use this method using Form GST 74. In short, it's designed to provide registrants with a threshold amount below 400,000 with a simpler way to do their GST reporting. This is shared amongst associates and it includes GST and HST that is collected when you're calculating that threshold. Instead of tracking all of their individual input tax credits on their operating expenses, registrants can just use the prescribed formula, which essentially gives them an ITC allocation that's built into the formula. They would still want to track their ITCs on purchases of capital assets because you can still claim those ITCs on capital assets that you acquire. There are some registrants who are excluded from electing to use this method, and they're in the top right-hand corner of the cheat sheet. Mostly it's those who are eligible for a public service body rebate. Additionally, law firms, actuarial firms, accounting firms, and other registrants who offer similar type services. Charities are also not eligible. They basically have their own quick method, which they can sometimes elect out of. So you might be wondering who would benefit from electing to use this method. Maybe you've got a client who provides IT services from their home. They've got limited operating expenses and they're just collecting service revenue. Or maybe you've got that client who seems to be able to keep their receipts on the big capital purchases, but not necessarily on their day-to-day operating expenses. And so they would get denied an ITC claim by CRA. Or maybe a client who mostly makes exempt supplies, but they have some taxable supplies, and this will provide them a better result than whatever ITC allocation method that they might be using. The rest of the sheet outlines some of the other things to think about. Even though the purpose is to simplify GST and HST filings, anytime you introduce a new set of rules, you might make it more complicated. For some registrants, this simplified method is actually going to be far more complex and too complex to utilize, and they're better off just using the regular method. So just to note a few of those different considerations, sales, they're going to need to be tracked by different GST, HST rates and by the permanent establishment that makes the supply. So it might be less suitable for clients with sales to multiple jurisdictions or from multiple permanent establishments. They might need to track sales in 5 or 6 different accounts rather than just one. A common mistake made is if registrants don't understand the limitations on this system, then they might choose to lease a capital asset like a vehicle rather than finance it as a purchase. They're going to have some unnecessary GST leakage since ITCs on the lease cannot be claimed. If they import supplies from other provinces with a higher HST rate, the election might require them to self-assess on the difference, which they might not have been required to do under the regular method. And as always, there's definitely a cost-benefit analysis that needs to be done and consider both the quantitative aspects and considering things like the added complexity. On the next page, you'll see a demonstration of how it would benefit a client who's kind of in that ideal no-brainer situation. Someone providing IT services from their home in Ontario, and all of their sales are to customers in Ontario, keeping it nice and straightforward. On the left, without the election, their net income before tax is $347,000, but on the right, since they essentially profit from the method, their net income before tax is almost $13,000 higher. Note that CRA considers this spread to be taxable for income tax purposes. The next 2 pages demonstrate a slightly more complex use of the quick method. We've got Bob the bricklayer, he's the 100% shareholder of Brickco. You'll see on the left that due to the fact that he has higher operating expenses, Brickco doesn't benefit from making the election. That actually lose about $5,000. The next page shows Brickco has incorporated a 100% subsidiary called ServiceCo. Brickco and ServiceCo have decided to enter into a joint venture. Brickco is going to contribute all of the inputs except for labor. Brickco is going to take a 10% markup on all those costs. ServiceCo is going to provide the skilled labor to install and receive that residual amount of the fees. Because it's a joint venture, Brickco and ServiceCo will report GST and HST separately as required without a joint venture operator election being in place. Only ServiceCo is going to elect to use the quick method. Brickco will continue to use the regular method. In the end, the corporate group's combined net income before tax is almost $8,800 higher than in the previous scenario where Bob the bricklayer was running both his labor and materials through Brickco and reporting using the regular method. In this structure, there will be a joint venture agreement that's required at the front end, and then annually there's going to be an additional T2 and GST return to be filed, but those should be pretty simple since the Service Co is just going to get a share of the revenue. You might be wondering what's the catch or safeguard against abuse. So BrickCo will have to transact with Service Co at fair market value. And so that's really the built-in safeguard against abuse.